Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappers. Welcome back to what many people are calling episode 89 of the Real Advisor Podcast, TRAP TRAP. My name is officially Lick Ninken, and joining me in the digital studio of doom are the three other horsemen of the apocalypse. Andy Ultra Heart, Carl Delavorci, the Voice Widger, and
Hello.
Alan the Storyteller Smith. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high energy review read from my very good friend, the Right Honourable Mr. Andrew Ursane Hart.
Thank you, Nicholas. We're back to one review today. We are at that desperate time, so please do go to the Apple Podcast app platform and leave a review for us, and you'll get read out on the next show. Thank you very much. This one is from Keith Hare, entitled Irreverent, Outspoken, Essential Listening, 5 stars. Love your work, gents. As a relatively recent Trappist, Epiphany 71, episode 71, I was initially a bit sceptical. Having enjoyed Nick's and Alan's various LinkedIn rants over the years, I assumed this might be a watered-down, homogenized protein shake of a podcast. But to my great relief, you are just as opinionated, irreverent, and outspoken as I had hoped. The content is excellent, with some very pertinent views and practical takeaways in every episode. There needs to be a new category on the CII website: chaotic, unstructured, but mandatory CPD, with a link to the podcast. Bravo, chap. 6 out of 5 stars. Back to you, Nicholas.
Lovely. Thank you,
much.
Keith Hare, for that review. And yes, as Ultra alluded to, please do keep them coming in. They give us a shot in the arm. That's the vitamin C that we need to keep on going.
Just worth saying, is that the last one we've got in our hopper?
Pretty
reviews?
much, yeah.
Right,
We're done.
so we're either going to have to change the format of this podcast, because we've had reviews pretty much every week. We get a lot of comments on LinkedIn and DMs saying, I love the podcast and what have you. Please, if you do like it, then just jump on it. I know it's not a very user-friendly format, is it, the Apple podcast? But it seems to be that's the place that they land.
Yeah.
So please jump on, go on the Trap podcast on Apple and tell us what you think. Good or bad.
We could always read out the one that Andy left for us, saying he was. he loved.
I'm a host of the podcast, and I love that too.
leading the podcast.
Always be closing. Always be closing.
Did he give us a 5-star? Because he gave me a 1-star on my podcast, but
Yeah.
that's another story.
That's true.
Right, back to
That's
Nicholas.
Good stuff. Okay, so obviously we had the launch of Trap Live in the last episode, and that's going great guns. We had a brilliant start to that, and I think we're down now to just checking with my people in the ticket hall. How many left? 35, sir. 35 tickets left apparently for Trap Live. So get on it. The Real Advisor podcast. Was it realadvisorpodcast.com? Get on that. Book your ticket. Come along. It's going to be a great event. There's a great event the day run by Brett Davidson. There's a great event the next day run by a friend of the show, Abraham, and his Timeline crew. Be there or be square. Right. Let's kick off with talking of going to something at the drop of an envelope. You two clowns, talk us through it quickly.
Go on, Andy.
Go on, Andy. Okay, so Alan and I had the privilege of attending the London Stock Exchange opening bell ceremony. It was a huge privilege to be invited. We got invited by Dimensional Fund Advisors. They were launching a couple of their new ETFs. It was all very strict on timings. As I say, once in a lifetime. It was a great event. And yeah, we got the chance to open the London Stock Exchange. It wasn't the most best of days in terms of market performance. We were
He
looking
made
at
it drop by 1.5%. Isn't that
we
correct?
were
Within
looking at a
minutes
sea of
of
red,
opening.
weren't we? We were looking at a sea of red when it opened. It's got these super fancy graphics.
Yeah.
It was amazing. I thought it was a superb morning. You know, I was heading home at sort of 9:10. So a lot happened in that short space of time. Over to you, Alan.
Nothing much to add. It was having worked in financial services all my life, never had the opportunity to go to the London Stock Exchange. Didn't even know where it was. But it's a beautiful setup, as you might
it's
imagine.
Huge. It's enormous, isn't it?
Huge,
enormous,
really, really professionally organised and well done. Of course, the assembled crew who got the nod, got the invitation, were there. The sort of private coffee and breakfast laid on, and the London Stock Exchange do it very well, and they roll out. And I guess back in the day, they call it, ringing the opening bell. I suppose it was a bell at some point at 8 a.m. on the dot. But actually, it's electronic now, so you press this electronic buzzer button and the market is open and trading starts. And in our experience, markets began to go into free fall within seconds. There was a slight funny side story that I got to share. Of course, I go to it's great. Coming back, I was just on the tube heading back to my area where I had a couple of meetings later on. I thought, this is monumentous. I'll do a quick post, tongue-in-cheek post on LinkedIn, because I had an image of Andy and I pressing the buzzer. Of course, the dimensional, senior people were the ones, or the sort of CEO guys. They actually pressed it. It was their ETF launch. It wasn't.
It looked like it was our day, didn't it?
But I just said, you're opening and people actually thought, because I said, on behalf of TRAP, the Real Advisor podcast, here's Andy and I opening, the London stock, as if the LSE would say, well, should we get these jokers from that podcast
you two
on?
boys here?
Yeah, and then, as happens, next thing I know, it's on the front page of bloody Citywire, New Model Advisor magazine. Advisors open the markets and then markets fall, go into free fall. I thought, oh my God, our friend Vicky Bell, shout out to Vicky, New Model Advisor.
She had to put a negative slant on it, didn't she? She couldn't have just celebrated our lovely morning.
Clickbait gets the
eyeballs.
Markets
dropped 1%.
Yeah, because we opened it.
It sounds like an awesome morning, to be fair. Declan King, our CIO, was there and he said it was great. He said he'd really love to go to the opening of a big one. But anyway,
he said he used to.
Nick is really hard thinking. What will I say back to that?
Well, he said the Irish Stock Exchange doesn't exist anymore, Carl. It was like 10 stocks,
We're
and then
gonna
Paddy
line.
Power got bought, and then they decided to close it down. He said you can't actually buy an Irish stock market like index fund. It doesn't exist or something. Anyway, just a bit of a side point.
Stick with the S&P.
Anyway, it was a fun day. We got to sign the famous book, didn't we, Alan? Every day they open the stock market.
You tried to sign it. You know what? It was pristine, unsigned. Just turned over the page for the new listing, and Hart gets the pen, walks up to be the first person.
No, I just pretended to sign it. Lady, come
then
running
quickly, move away, step away from the book.
Anyway,
that was fun. Great day, well organised by Dimensional, and good fun.
Yep, thank you.
Right, Wodge. Your pal, Terry Smith.
Well, not my pal. Andy's pal, Terry Smith, yeah. So, in the interest of trying to, in the interest of trying to see both sides of every story, I said I'd listen to this interview. It's a podcast called Behind the Balance Sheet. And basically this guy seems to interview a whole load of active fund managers. So I listened to this Terry Smith one, and I put the link in the show notes. I'd encourage everyone to listen to it. He didn't impress me much. I thought some of his answers were almost borderline condescending. So look, we did have a chat offline about this. Maybe I'm being too harsh. Maybe the guy does know everything, in fact, and I should give him the credit for that. But I really do think we should do a longer piece on star fund managers, because for me, it's a myth, and it's a myth that needs to be busted. And I think we should be doing that because, I don't know, talk about a guy who just is so sure of himself and yet so fundamentally wrong, in my opinion, based on the evidence that I have studied in my 30-year career in this business. I think it's a longer piece we should do in the short term. This guy has also interviewed, when I look back to other episodes, that guy Nick Train. So he's getting them all the heroes in. So totally the opposite of what I believe in. But it's good to challenge yourself sometimes. But it kind of annoyed me. I listened to it on a walk, and I didn't enjoy the walk.
I thought he's a very...
Probably says more about me.
I often thought he was a very articulate communicator. I've seen him do
He
his
is,
AGM,
but
very
and all that.
straight talking.
He's put forward as kind of the UK's Warren Buffett. Straight. He only buys value, buy and hold. He's not going to get caught up in the Mag 7 frenzy.
Okay,
and all
well,
that stuff.
you can track tons and hundreds of speeches of Warren Buffett on YouTube, and I've gone down the rabbit hole, and I always get something out of it. I got nothing out of this one. So if you're comparing and contrasting those two people, please do listen to it and see what you think.
Yeah,
yourself.
fair comment. We should do a deeper dive on
I've
this.
consumed a lot of Terry Smith stuff, his annual shareholder meeting, a lot of the stuff he puts out, his owner's manual. I think a lot of the values and principles are aligned, Carl. You say it's like totally opposite of what you think. Obviously, you generally buy the market and you let that do its thing. He buys individual companies, but a small amount. I think his latest holdings is about 30 or 35. So he's got very strong conviction. So there is similarities
which is wrong
Buffett in his early days.
But he's totally wrong about them. And so I would extol the virtues of buying a fund with more than 10,000 stocks. So if they're not polar opposites, then I don't know what is.
Yeah, but that's the implementation. You both believe that markets work. You both believe not using derivatives. You both believe not shorting.
I don't. He doesn't believe markets work.
He believes he's smarter than everybody else.
Work.
Him and his analysts.
No, he doesn't believe mispriced securities because the market doesn't work. That's his worldview.
Yeah, exactly.
Oh, I mean,
he's written a lot about something. I can't remember exactly, but it's like companies run by idiots. There's some very derogatory phrase he's got about.
Yeah, but if he's trying to explain
to buy a company that could be run by idiots, but someday it will be run by idiots.
He's met with the CEOs and boards of various companies, and he's come to the conclusion that they're idiots.
If he's trying to explain a concept that he believes, but maybe the vast majority of people don't believe, he gives his evidence or his proof, and it's condescending. He kind of has a little laugh at the end of the sentence, and it's like, I want the wisdom from Warren Buffett. I do not want to be listening to this guy. And look, when you sent in that annual shareholders letter way back, Andy, and I read it, and you loved it, and I went, "Oh my God, this is terrible stuff." So this only confirmed what I already believed, which I suppose is.
And that's the beauty of the world. Everyone has their opinions, which is
which
is great.
We'll definitely be talking about that later on, and that is I'm okay with that, but. I suppose to have the courage of your conviction and to say that, no, Terry Smith might shoot the lights out for the next 5 years and prove me wrong, but I'm still sticking with it. And in the long term, I think the evidence tells me we'll be right or very close to right.
Well, as the saying goes, you're entitled to your own opinion, but you're not entitled to your own facts. And he's underperformed now for the 5th consecutive year. Every superstar has a bad year, a couple of bad years. 5 years on the trot. Yeah, that's going to be hard to defend.
Anyway, so. I propose over the coming weeks we do a deeper dive in this. We've probably done a much deeper dive than we should have today, but anyway, I propose that, and I think we should all do a bit of research into that.
Yeah. Okay.
On a similar theme,
let's keep it going. Alan Smith.
Yeah. So on a similar theme,
funds Sweden.
Well, this is just another story. It comes up with frequently, unfortunately. I just saw this the public sector pension schemes, local council. It was in Scotland, in Aberdeen, all places, and they piled into a series of Swedish wind farms, as you do, as their allocation, because it was considered defensive. Income generating and what have you.
We have some solar stuff going astray here if you want to come over here.
Well, their allocation's already been taken.
Must be
they might have a new allocation because it's gone to zero. It's basically been wiped out. The project didn't work. They've lost the money, or not. The taxpayer, I should say. The taxpayers lost the money. This is a public sector pension scheme. Oh my God, the amount of times this comes up, and in a time when finances are tight in the UK economy and taxpayers funding all these things that taxpayers fund, one of which is public sector pension schemes, effectively funded by the UK taxpayer. And this would be the simplest thing. These are all long-term. They obviously need some actuarial modeling because they've got people who are receiving income. They've got people who've just joined the scheme, will be retiring in 30 years from now. It needs that. If there's nothing is better suited than a long-term buy and hold simple investment strategy. What the hell Are they buying Swedish bloody wind farms within this and then losing the money?
Because smart consultants come in and sell them the dream.
Well, they're now.
Rinse and repeat.
I can quote this. I've posted a link to the articles in the Telegraph. There's a few other papers as well. So they're now suing, which is legal stuff. Hermes, who are some, not the
Hermes,
clothes thing, Hermes or whatever they're called.
Yeah.
Pensions consultants, investment advisors, suing them, taking them to court. That would be a big, litigation battle with legal fees and what have you to try and get their money back. I mean, what the hell are they doing? It's just really annoying when you see these things going on. And the last thing I'll say in this is when you see the great model for this, because they'll say, well, it's a very large, I can't remember how much, but many, many tens of billions are in this particular pension fund. And they'll say, well, it's very large, we need diversification. There's very few bigger than the Norwegian sovereign fund. And they are pretty much long-term buy and hold global equities with a bit of bonds, a bit of real estate or something else. But
80% global equities,
yeah, with a couple of trillion that I think they've got.
Yeah.
So just flagging that up, push back on it wherever you see it. But the same things apply to other in the retail world as well. You're really rich, Mr. Client, will give you something interesting, something spicy, something to allocate. We'll only do 10% allocation to
the richer
Swedish
you are,
wind
the more
farms.
investment lies you're told.
Yeah.
The richer you are, the more investment lies you're told.
Okay.
Spot on.
Okay, so I'm afraid with these stories, but they are. We keep on talking about them because they keep on happening and they do affect real people. It might seem distant, arm's length stuff, but these public sector pensions, if they go down the Swanee, that will be a cost we will all bear. Right. Brief. Transact family linking. Ultra.
Do you mean brief? I think this is quite interesting development in the platform world. So this is a good news story. A good news story. Transact have they have something called family linking, whereas usually Mr. and Mrs. they aggregate the fees across Mr. and Mrs. But now they've extended it across families, and on the 1st of April this year, they're extending it further. So they're basically extending it to link siblings, partners of siblings, nieces and nephews. So they're really taking the point of view of applying their fees across the aggregate of the whole family. So I think it's awesome. Good move forward. Really good on sort of family planning stuff. And the examples they've given of families with a few million quid, the fees are going to come down drastically. I think it's brilliant news, and other platforms should hopefully follow suit. I mean, siblings, partners of siblings, that they don't even need to be married. That's a loose connection, but that's the devil's in the detail. Over to you, Alan.
Well, that's my question. I think it's pretty common. I think most platforms nowadays do offer family linking, but once you see friends of a friend of a guy I met down the pub, my girlfriend's brother. But so my question is, how do they know? Do they just take the advisor's word for it? This is the partner of my son-in-law or whatever. Do they just take?
There's obviously some good faith on the advisor's
you're not going to have to prove it if I'm. So
it's they're just extending it wider, which is I think
it's a positive, definitely,
massively positive. Yeah.
Okay, good stuff. Okay, so it's me next on the slate, and Rachel Reeves' last budget we know about. She proposed this idea, which has been mooted ever since Labour got back into power, that ISAs were going to be fiddled with in some respect, and the fiddling that she's done coming in next year, April 2027, is to reduce the amount of money you can hold in a cash ISA from £20,000 down to £12,000 unless you're 65 and over, which is an arbitrary date, doesn't even link into the sort of the current state retirement age. You think if you do it in any way, you'd maybe link it with that, but no, 65 and over, you can have £20,000 in cash ISA. 65 and under, you can't. 12,000, and apparently it's just a complete dog's dinner. It's a good article. There's a link in the so-called show notes from Sam Brodbeck at the Telegraph, who's one of the better journalists out there, actually. And he tends to hit more than he misses. And there's a euphemisms, but the people within our industry dealing with the Treasury say it's being challenging, which is a euphemism for the Treasury don't know their arse from their elbow. And this thing is going to be, I think, pretty hard to manage. Because people are going to money market funds. Are they cash funds? The idea, Rachel Reeves, on the surface, our prima facie reason for doing this is to get people invested in UK companies. This ongoing thing to shoehorn people. Well, even if they do move from cash ISAs into equities, they ain't going to go into the UK. They're going to follow the great companies of the world, which means predominantly, with a global portfolio, which people are much more in than they used to be because the home bias thing is evaporating. They're going to go into US stocks predominantly. So, Yeah, it's just like cash ISAs have been one of the success stories of the UK financial services over the last 3 decades. There, when they were PEPs formerly, then they became ISAs, and just leave alone. Just
because of their simplicity. That's
why. The simplicity.
Just I know it. I can put this amount in.
So good.
20 grand, tax-free income, tax-free growth. Lovely, beautiful product.
Beautiful.
Now she's dabbling with it.
Yeah,
tinkering.
So there's a good article, and also there's a link to a LinkedIn post that was put on there about this move as well. And I've just lost the guy's details. I'm sorry about that, but the link is in the show notes. And IFA wrote a really good piece about this as well. So what can you do? It is what it is, but it's just going to be very difficult to manage this, I think. And I don't think it'll have the outcomes that Rachel Reeves has said on the surface she wants to achieve. I think really what she wants to do is get a bit more tax and get less money out of cash ISAs and more money into taxable cash accounts. Okay. Webinar watch.
Yeah, I'm told that some people to tick the box in their CPD log into lots of webinars and actually don't listen to them at all. I thought that, I'm told that happens sometimes. So I came across an absolutely brilliant webinar. I would say the best one I've ever actually seen in terms of CPD for 1 hour. Aviva did it. A guy called John Deehan there was the, I think that's his name, I hope that's the name, was the MC. And he had 2 economists from Ireland, Jim Power and David McWilliams. And they kind of bounced off each other a little bit. Not that they disagreed necessarily, but they were really, really good. They did a kind of, the first half of the show was where we are at in Ireland, which is really important because obviously we have a lot of good stuff happening, but there's challenges coming down the road, and to, I suppose, bring people to that, to face up to those issues that we do have. And then it was kind of the worldview. But look, just credit where credit is due. It was absolutely brilliant. More of that content, please, Aviva and everybody else. I'm not sure, I put the link in the show notes. I'm not sure if the UK advisors will be able to watch it, but if you can, I think you should, because it will give you a good feel for actually why Ireland has been successful, the challenges it faces. But it also does the kind of, here's what's facing us from a world economic point of view as well. Really, really good. Bravo, Aviva.
Okie dokie. Good stuff. Yeah. And of course, we watch all our webinars from start to finish. Watch. How dare you infer anything else?
Answer the questions at the end. Get the old certificate.
Just told that's sometimes something that happens.
Okay. Who's next on the slate? Next on the slate is.
Okay, Andy.
You can run with this. I'm going to go have a lie down.
It's back to me. This was big news last week, wasn't it? Mr. Trump doing his stuff in Davos. I've watched the full speech. I think you boys did as well. Maybe Carl not. We'll find out in a minute. I thought it was a bit of a masterclass, if I'm being totally honest. Incredibly well written, incredibly well delivered. Speaking to a room of the rich and powerful. He set it out really well. At first, he basically said, this is what I think America is doing well. This is what we're not doing well. This is what we're changing. This is what we're on the front foot with. And he's very honest and open, shared anecdotes, off-the-cuff stories. And he was basically just saying that Europe is heading in the opposite direction to the US and it's potentially going to be disastrous. So I just thought I'd mention it. If you haven't watched the full speech, I recommend watching the full speech because the media's report on it is not what I watched from the full speech. That's that really. Any other comments from you boys? Did you watch it? What was your thoughts?
I watched it, but I don't want to get into the political thing. We have our views on Trump. And
come on, Carl. You got a view?
So,
all right,
no,
Carl.
I think it's a joke that you'd even put it on the slate, to be honest. Not happy about that at all, boys. Seriously.
All opinions count. That's
not on politics. We've always said that we leave politics out of this. I don't think that you should have put it on the slate, and I'm annoyed.
Yeah, I agree.
It's just stuff that's
well,
going on in the world.
It does flow into
it's a huge impact on what we
global
do.
economics, capital markets. What I would say is, Andy, if you see the interview with Howard Lutnick, that's interesting.
He was there as well. Yeah.
He's the Commerce Secretary, and he's the guy from what's the name of the company that he had that sadly was sort of hit by the 9/11.
Yeah.
Okay. But whatever. Trump has surrounded himself with some very, very smart people. There's no question about that, and they are kind of driving the global kind of geopolitical situation right now. So,
in your opinion,
in my opinion, what's next,
okay,
Nicholas?
All right, let's move on. Let's get away from that. Which means Zen
Smithy.
plans.
Just a quick one. I had a conversation with the founder of this company recently. In my firm, we've often tried to this idea of we call it an ice pack in case of emergency. Your client gets hit by a bus, drops down dead, all their information, wills, details, powers of attorney, policies, bank accounts, all that sort of stuff. And it's useful. I mean, some people have their own spreadsheet at home. Some people have a piece of paper, a document. Zen Plans are a company. There's a few companies around that do this, but I had a meeting with them. It looks really good, is what I would say. Go online, like a digital storage. Of course, you can save it, print it off, do whatever you want to do. But if anything untoward happened to one of your clients and the spouse or the family wanted access to information, it looked to me like a really nice, elegant solution. The other thing I found quite interesting was what they call legacy assets. So, all the photographs you've got on your phone, I've got thousands of photographs and videos and family things, and you've got your kind of Spotify or whatever music accounts. There's a whole bunch of things that are digital that can disappear if the person becomes deceased, and without trying to navigate through that whole thing. So there's a process to deal with that. I think even though I just checked out afterwards, I sort of heard about this but never utilized it. On the iPhone that I use, there's a legacy contact where you can put people's details, and then you won't have to sort of navigate through all the passwords and what have you. So I just thought it was quite useful. Check out Zen Plans. Posted a link to the website in the show notes. Could be helpful for some.
Okay, thank you very much. What are we on to now? We're on to So Quill. So okay. Oh God, all our careers, and for the last 150 years, with profits has been a part of the industrial side of this thing of ours, and it still is remarkably popular. And so I see that Quilter are launching a rival to the M&G Pru Fund to be managed by Standard Life. And again, this is a link to this is in the show notes. It's a Citywire article, and priced at 1%, well 0.99, conveniently just under 1%. But then you add on the platform fees and your advisor fee, and you're probably looking well over 2% for a managed fund. Designed apparently comes as demand grows for solutions that provide clients reassurance from the uncertainty of investing. And then it goes on to explain how the bloody thing works, and your head starts to boil. It is understood the Standard Life Smooth Fund will be built on the same bravura technology used for M&G's Pru Fund, which uses an expected growth rate smoothing mechanism. In this mechanism, Standard Life project how much the fund should grow by over the long term, and the fund price accrues at that rate daily. If the smooth price diverges too far from the actual market value of the fund's holding, the price and or EGR rate are adjusted. I mean, once again, I think I really don't. I was brought up in a unit-linked firm, so I've always been unit-linked, right? So I was never sold with profits. I never saw the value of them. I detest with profits. I detest these products. They're for lazy advisors who want an easy ride. And by the time the poor sods are in these, run out of money at age 83, the advisor's buggered off or is dead. And it's just they should be just yuck. Any views?
Nick, sorry if you've already said this, because when you started explaining the product, but I lost the will to live. So you might have already said this. I wasn't paying attention to the last 2 minutes, but I did look at.
I appreciate your honesty.
But before we hit the record button, I did have a look at the fund and sort of lifted the lid at all the kind of small print and what have you. And what I found quite intriguing was that, and I can't remember exactly, I think it's something like a 5 or 10% adjustment. So if the underlying, look, I grew up on with profits, and I did recommend them in the early days. And then sort of saw the light later on. But if they got this thing called, it used to be called market value adjustment. So it's a fund that just goes up every year, but the underlying assets, obviously they go up and down every day. They own equities, bonds, whatever. And then if someone wants to get the money out, then they do this adjustment, and they basically give you what you would have had if you're just in a unit-linked fund. But if I looked at this correctly, if the fund, say, falls, the underlying assets fall by more than 5%, then they'll just adjust it. So you will experience, you're paying all the extra for this smoothing thing, but if there's any sort of material adjustment to the underlying assets, you're going to get that anyway. So it seems to me, unless I'm misreading it, and Pru can get in touch if they want, or M&G.
All their lawyers.
And just because it seems like a complete waste of time. So let's say you had a COVID, your market's down 20, 30%. You're going to get this adjustment kick in within this fund in order just to reflect the actual fall in the underlying value asset value. So it looks like, a complex product that doesn't really deliver much in the way of solutions. That's my take on it. Best of all.
Yeah, and anything that's overly complex is not good in the fund management world. It only plays into the hands of the fund manager. It does say about some limit. It limits it to 7.5% withdrawals per year. Also in the article, it does. I mean, the reason why they're obviously launching this fund, the Pru fund range now stand at 64 billion. That's a huge fund range. So, it's another reason why they want to get involved in it. Over to you, Nicholas.
Yeah, just to close on that, as a wise man once said, with these products, you're giving up, to mask the temporary decline, to mask the temporary downward volatility, you're giving up a large chunk of the permanent advance, and that will always be true. I've just found the story I alluded to earlier about cash ISAs on LinkedIn by a guy called Robert Lewis, who runs an IFA firm called Celtic Financial. So the link to that is in the so-called show notes. Right. Oh, Smithy, yes, I feel your pain on this one because we're all three of us are going through this.
God. First of all, Nick, can you lower your hand? I've always wanted to tell you that. manage your admin. This is if you own or I think director or whatever of a limited company in the UK, you've got this digital ID process to go through, and I've been being chased on this for a while with Shireen and then our accountants and get around. It's like, because I knew it was going to be a ball ache, and I thought, right, fine, I'm going to sit down, get all this stuff done. I've shared some of this stuff with you boys on our private message, but I couldn't possibly. It was and by the way, it's still not done. It went round and round the houses. You asked you to download an app, and you download the app, and then you got to upload your ID. But the only ID you would accept was Her Majesty's Services veteran card. So I haven't been in Her Majesty's armed services. So the only thing you could do is a veteran card. He says we are going to be able to take additional documentation later. I thought, thank you. And so it says go on the website, and then you go to the website and you can't do it. And on the website, it's like entering, what do you call it? The 7 circles of hell. Because then the website sends you back to the app, and the app sends you back to the website, none of which work. And then I tried to do a chatbot thing and just was waiting. And eventually I got a message with somebody, literally 1 hour. I just had it on in the background. And an hour later, somebody gets in touch with me, and then she tells me to remove the app that I downloaded and reinstall it. And you're just thinking, oh my God! I mean, how long is this going to take? And it went on. This is just a small sample of the experience I went through. And then I tried, because my accountant said I think it's fixed now. So I tried again the following day. It's still not done. And I would rather just see them in court or something. Just sue me for not doing this, because I've got the receipts. There's screenshots of everything. I tried my best. It was a shit show, and I just wanted to share that. If anyone else is going through it, you will have to experience this that I experienced. I don't agree with it anyway. Having to do ID for this stuff. I think that's with the amount of cyber breaches that government websites have. I don't think it's great to show all your passport details and personal details.
I mean, I've done it for one of my companies. I'm not sure which bloody one, because it's not. I think it might be Values Division. If not, it's one of the other. Obviously, one of the other.
You have to do one for
clear with the government gateway login. It doesn't seem to sort of suggest which company you're doing it for. It's like, so I've done it for one anyway, and I'll just wait so I get more chaser emails. But it is a ball ache.
Oh, it's terrible.
Okay.
Oh yeah, just one other thing on a different subject. If there are anyone, and there is another conversation we'll come back to, I'm sure, but it's been quite active in the last year, 18 months or so. Financial planners kind of seeing the light, looking to move to other firms and embrace proper full-fat financial planning. Get involved with that. There's a number of people that we all know that are kind of migrating across, setting up their own businesses, going to other firms. Right now, lots of activity. It seems that there are, for some reason, don't know why, but in Norwich, there's quite a few really good financial planners in Norwich. So if you are a firm based in that neck of the woods and you are looking to bring in good quality people who want to do the right thing by your clients, there's a number of them around. And again, like we've done in the past, send them over to James. James Barden seems to be able to help people at least have a conversation with. So I just wanted it was a request from a few planners in the Norwich area just to say, can you give us a shout out?
Every IFA owner in the Norwich area is now looking around at his team going, was it you?
Well, there we go.
And we have James
free
on.
market,
James will be
isn't
on a
it?
future show in the topical tidbit section at a later date, which is good stuff. Okay, I'm just conscious of time and conscious of the fact we have a guest. So you've done the full fat financial planning firms in Norwich. Thank you, Wodge, the Ireland Financial News Desk.
Yeah, there was so many things here. I'm literally going to fly through them because they're all kind of relevant right now. So first thing, I put links to all of these. Black Bee loan note provider went belly up. They're bringing the owner of the firm before the courts. Actually, by the time this goes out, he'll have been before the courts. Solar 21 in the news again. So they're arguing over who the liquidators might be, that they feel that the investors are being unreasonable, which I thought was bloody ironic. The good news about these loan note guys all being before the courts is I think the public are being educated that this is danger zone. Central Bank have new rules coming in about regulated IFAs selling unregulated products, so it's all good. Bit of a mad story. A guy who passed away last year. He ran a business in the Midlands in Ireland, and they went to sell his business back to the various providers. And it seems that there was an awful lot of fraudulent activity, and there's 3.7 million gone. So we can get rid of all these loan note providers and all that. But as we have always said, there will always be bad actors, and we just can't legislate for everybody, unfortunately. People should follow in the Business Post Investor Fin. So it's a fictional character. It's actually 4 business journalists in the Business Post, and they've embarked on this starting off their investment journey. I don't agree with everything that they're doing, obviously, because some of it is direct shares, but they are doing some ETFs, that kind of stuff. But their last article was a big kind of expose on the tax treatment of funds basically here in Ireland, which is really good that it's getting an awful lot of coverage now, because there is this tax review to come up over the coming months, so we would love to see that bloody deemed exit tax after 8 years just done away with and the tax rates reduce. It would definitely open the doors to creating an awful lot of wealth in Ireland. And then finally, the Elon Musk and Michael O'Leary spat over the last week or so. We're very proud of Michael O'Leary, and I think he did a great job standing up to somebody. He just made fun. He made a joke out of the fact that somebody was publicly calling him a retard, which I don't think is okay. Anyway, enough said.
Okay, good stuff. Thank you for that. Donald Trump. No. Platform cash rates. Ongoing thing. We talked about it last year. Still a big bloody thing. I got an email from some source showing me, and I'm quoting AJ Bell here, but it applies to various platforms that don't seem to give much back to the clients in terms of cash rates. AJ Bell, their cash rates when you have money on deposit in a cash in your platform wrapper start at 1.19%, go up to 2.13 if you've got a bit more money with them. Comparing that with say Transact, which is they're paying 3.6, I believe, currently. And it just and I cocked up earlier. So the article by the IFA was on this subject, not on bloody cash ISAs. My apologies. I know, my apologies to Robert Lewis. He wrote a very good article about this and saying that platform due diligence is not all just about looking at the quotes and the costing of the platform. Because if you've got a platform that's paying you significantly more cash than a rival platform, that is an effect. That's an investment return that should be factored in. And I still think it's pretty outrageous. And platforms are all different. Friend of the show, Fundment, sponsor of the show, for argument's sake, they don't charge a platform fee on their cash. Other firms do charge a platform. It's just it's a real mess. And do I want the FCA to get involved? I always think regulation generally leads to other bad things, which leads to more regulation. It's the opposite of a virtuous circle. But I don't know. You just, if you're a new advisor, if you're a newbie, just have a look at the cash thing. Andrew's wagging his finger at me. What have I done now?
No, Smithy just said, vicious circle.
Vicious circle.
Virtuous.
Vicious circle. Thank you. Thank you.
Can we just give another shout out to Robert Lewis, saying that he's been mentioning?
Sorry, Robert. Nick has completely messed up your contribution.
I think I got it right.
He keeps putting his hand up on the digital thing and then not putting it down. So he's
I did it once. You're more than welcome to do all the stuff in the background that I do here.
But I think that's a good point. I remember looking at one thing that the cash rates that Transact were paying effectively covered the cost of the platform fee.
Yeah, correct. Because the average holding is about 8 to 10% in cash. Therefore, the rebate would be equivalent to a free platform. But that doesn't come up on any other sourcing software.
Yeah, you wouldn't do it on a comparative. If you're just looking at pure, like, what do they charge a basis point for this £1 million SIP or something?
It accidentally becomes,
really
potentially the
worthwhile.
cheapest
Good
provider.
Great point, Nick.
Okay. Thank you very much,
Lewis.
Smithy. Thank you. You've redeemed yourself in my eyes. Right, we'll come to the final thing, I think, on the slate today. While Andy's going through this, I've got to make a phone call, guys, as discussed earlier. So bear with me, and over to you.
Right.
Andrew.
Okay, so this is the famous Vanguard fund range of Vanguard Life Strategy. They're making some big changes. They are reducing their fees. This fund range is currently sitting at 52 billion, so it's a very successful fund range in the UK. Their fees are going from the quoted annual management charge of 0.22 to 0.2. And they're also reducing their UK home bias. I suppose a brief point on this. I think they're currently UK home bias on, let's say, 100%, the Vanguard 100% Life Strategy Fund is 25% of the fund is UK exposure, which we all know is...
That's an awful lot, Andy, isn't it?
It's huge, huge. Yeah. Across, if they were to do it currently representing what the UK is, I think it's about 3.5% and declining. So the fact they've gone for 25% is massive. However, in 2025, that was good news for the fund range. The UK outperformed, a lot of the other markets that they were involved in. But they're moving it now back down, from 25% to 20%. So they're reducing the fees and reducing the home bias. In their bond portfolio, some of them are 35% UK exposure, and they're moving that down to 20%.
So I saw
I think whatever they do, people are not really going to be that bothered. I mean, if they reduce it down, if they reduce it up, people are just going to have a
on
problem.
the UK equity exposure. That seemed like a rounding error. 20. I saw that the headlines were Vanguard.
No. Sorry, Alan. Why is that a rounding error?
20% to 25% to 20%. It's still massively overweight.
Sorry, still massively overweight. Yes, correct. Yes, correct.
I mean, you think
they should have gone from 25
to market cap
to 10? Market cap. Yeah, I
That's
suppose
an awful lot of money be moving in a 56 billion fund, though, I guess. So,
that's the other thing I think about, relating it back to Nick's earlier point about Rachel Reeves and moving around the deck chairs and the Titanic, like move your ISA rules and complexity. Look at the billions just in that fund that have just washed out of the UK. Just 5% of.
Yeah, but it's arguable, that it was
in
in the wrong place in the first place. It shouldn't have been so much in the UK, really. They sort of
but it's still 20%, which, as you say, the market cap weight is 3.5 or something.
Yeah.
So it's a huge bet on the UK.
Anyway, good news that they've reduced the fees, which is what they've done in that fund range from the beginning.
Yeah,
I can't remember exactly what it was at the beginning, but they've chipped it down by 2 basis points every couple of years. And they're slightly rejigging the asset allocation location. So,
in terms of framing, Andy, like saying that it's going from 22 to 20, 10%.
No, 25 to 20,
yes.
Carl.
No, 0.22 to 0.2.
Oh, the
10% reduction, Carl. Yeah.
Right.
Yeah.
You frame that in a 10%
Sorry,
reduction.
I frame it as it's going from 0.22, Carl, which is basically free, to 0.2, which is also basically free. Like, for me, it's so irrelevant, the fund cost being that low. You get access to global markets for basically free. I know
actually,
it's gone from 0.2
not telling Vanguard how to market their stuff, but because it's totally irrelevant, you should be saying that's a 10% discount.
But what Vanguard do really well, and the leading company I see who do this, as they continue to grow, obviously they've got fixed costs running a business. As they, another 10 billion, another 50 billion, they give the benefit back to the customer. And I wish more companies would do that. I'll say no more about that. But as some funds have gone from a couple of billion to 30, 40, 50 billion and more, and they don't reduce the fees. A lot of the organisations.
Vanguard's biggest fund, which I think is the VTSAX, is over $1 trillion, and I think they charge 0.02 in the US.
Wow.
I know that 0.02 is a chunky amount of money on a fund over $1 trillion, but I mean,
it's free. It's free.
It's basically free.
Yeah.
All right, over to you, Nicholas.
Nick, I'd say you're muted. It's just all a bit of a shit show.
This is like...
We don't have any guests coming on, do we? Who demand professionalism.
Still muted, Nick.
You're still muted, Nick.
He might be on the phone. He's still muted.
You're muted.
Is he speaking to us or not?
Maybe he's speaking to our guest.
I know.
No.
Uh-oh.
Your little thing is even on that you're muted. You need to press that.
Oh, yeah,
button.
yeah,
Oh,
yeah.
Jesus
Yeah.
Christ, sorry, right.
Well done,
Okay,
Nick.
let's move on to
Oh,
meat and potatoes.
Lord.
Let's move on to meat and potatoes, and we're going to let the guest in. So,
Absolute shambles.
crossing my fingers for
God.
this. Let's hope this works.
Let's replay that bit.
Here he is.
Hey, there's somebody at the door. Oh, there's somebody at the door. Come on, there's somebody at the door.
And our guest looks suitably petrified as we play the silly jingle. Ola Abdul, how are you, sir?
I'm very good, guys. This is some dramatic setup you've got. What is it? What is that noise I got as I was coming in there? That was very loud. Was
The
very
jingle we
welcoming.
play, Ola, whenever we have a guest onto the show. Dear TRAPist, this is Ola Abdul, the founder and CEO of Fundment. And of course, as you're listening to this on Thursday, this is the day of Fundment Live, their Advisor Edge event. 3 of the Trap Pack will be there. We'll be here today to meet with all the Trappists and all the Fundment advisors. It looks like a great event, Ola. You've obviously put some time and attention into it. I hope the day goes as well as you're wishing it to go. Thank you for coming on the show. We know you're a busy boy, so we're going to fire some questions at you and just see how the conversation goes, Ola. But it's very loosey goosey, and you can say what you like, just nothing slanderous, if that's okay. That's our...
We leave
I
that
don't
to
know
Nick.
if that's going to be easy, but I'll try.
Okay, good. Man.
Okay.
Good man.
Ola, thank you very much for coming on the show, my friend. I've known you for a few years and you're doing some great stuff at Fundment. So I am opening the questions. So when you founded Fundment, what problem were you trying to solve?
Oh wow, that's look. People have often asked me this, and there is a polite answer, but there is also the kind of I don't know what you call it, sort of hero answer. Which one do you want, both or polite? Polite or heroic one? Okay, I'll give you both. So obviously, something you may know is our on the ETF called. But I also noticed that advisors, to this date, actually still don't use ETFs well, purely because of the infrastructures that support it just aren't there to make that easily accessible. And it's still issues that I get invited to speak on every now and then. So I thought Fundment could be that company to build the infrastructure to to power ETFs in the way people use it for financial planning. That was what I wanted to do. But it didn't take long to realize that there are 5 bigger problems, around financial planning workflow, and I've been building Fundment, since then to address that problem. So yes, it started with the product problem, but then it's much more of our financial planning problem that we're trying to help solve.
Okay, great stuff. Ola, I think there's a theme currently with Fundment that you're helping advisors. The idea is, the message you want to get across is you're helping advisors to move faster, to act faster. What does that mean in practice?
It's not a slogan, and we're not trying to trick people, believe it or not. We actually are trying to minimize the gap between customer outcome and the judgment that you need to take between that. So the work advisors do is very elegant, as you know. They do all this great work with understanding their client, listening to the client, and then they make a call on what is the right home for that client. But often between that process and the client getting the outcome that they expect we're going to get, things go. Transfers just never mind being slow. They're just not visible. You don't even know what's going on. All the workflows that you need to manage drawdowns, making payments on time and accurate just don't function properly. So the whole theme is to try and hopefully help advisors begin to understand that we understand exactly what is involved, and we're building to solve that. So yes, it's to shorten that time and that gap between very great customer outcome, which is what everyone wants, and the judgment that advisors are putting in. Does that make sense? Did you get it, Nick?
Yeah. I mean, your platform is very, very slick, and I think you are, and you still are. You're ahead of the digital curve compared to other platforms.
Can I just ask about that, just to be clear, just to jump in on that question? Ola, you and your team and software engineers, you build your own technology in-house, unlike some of the others who outsource. Is that correct?
Sorry, Nick, I missed that. I think that was a break there. Sorry, if you just want to come back.
Sorry, yeah, it was me, Alan. Ola. I was just looking for some clarity on the actual underlying technology. I understand you build it in-house. You've got your own engineers. You build it in-house. You don't buy it outside and sort of wrap around it. You build your own tech. Is that right?
That's absolutely right. And it's not because we enjoy pain. It's just that that's how you actually help to move the industry forward. Genuinely, there's far too many moving parts, as you build. Most people think, a platform, I've had people say that it's just a portal and it's a trade, and that's it, done. People often, in my view, undersell, maybe, I don't know, for whatever reason, what these platforms actually are. We believe there are so many moving parts to it. And I've been on record for saying you could easily carve out, multiple businesses within what we call a platform today. You could carve out a payment business out of it. You could carve out a pension business out of it. You could carve out reporting business. You could carve out trading. I mean, it's all sorts of things. So therefore, to really deliver that sort of really simple workflow that just that I think it's become an industry knowledge. I'll just say it anyway. We're working on setting up, I don't know if I should say, an insurance company based out of Dublin.
Oh, wow.
I know. This is a tricky one. I think I've been told not to talk about it, but I can't. I'm a big mouth sometimes,
Too late.
You're amongst friends, Ola.
No one listens to this anyway.
I know.
Tell us more.
So yeah, we've been engaging with the CBI. I think we're going to set up, the product over there, from NetStack, and then bring it back into the UK to issue our own offshore and, shortly afterwards an onshore bond wrapper. All of that within a single, infrastructure that, already it's been well received by UK advisors. So, Alan, it's a long-winded way to answer your question, but
it's great.
Can I jump in there? The connection is great. I might have missed some of that, but did you say you're getting a license with the CBI, the Central Bank of Ireland? Or
yes, yeah.
For offshore bond into the UK, Carl.
Yeah. Okay. So I did get that piece,
yes.
Right. So therefore, can we expect the Fundment platform in Ireland? Will the advisors in Ireland be able to use the Fundment platform? Is that part of the plan?
I don't believe so.
Oh, please.
Carl, I don't believe so. Look, maybe that's not I want to take offline. I'd like to understand the Irish market more. I don't know anything about it, other than setting up the insurance company, on which we've been spending a lot of time trying to understand it. And so far, I think becoming a bit of a mini expert on that, but on the wider Irish market, on the pensions and everything else, how people do it, I don't know. So I would love to tap your brain on what's the best way to do that. I don't believe we will, but I would like to know anyway, just to see what's possible.
Yeah. Well, look, we need a bit of competition over here, and we certainly need competition from a company that's putting tech at the leading edge of everything that they're doing. Can I just ask another question? Because obviously we're probably a good bit behind here in Ireland in terms of the capability of the platform tech, right? So we're kind of just almost catching up to what you guys in the UK have been used to over the last probably decade or more. Where do you see this going? Because obviously as a tech company, you can't rest on your laurels and say, we've built this now and that's it now. Let's just get the customers in. Yeah, you have to be looking ahead all the time. And obviously we've got AI, and everyone is saying that, the tech advancements over the next, not even 5 years, the next 1, 2, 3 years are going to be enormous. But where do you see it going for the platform business? What are the big structural shifts we can expect from Fundment going forward?
I think Fundment, as you rightly said, in fact, I spoke to one very, very senior, very experienced platform boss and CEO many years ago, and I think that just clarified for me the shift, in terms of where Fundment is and where those companies were, who said that tech is kind of a cost center that just stays in a little corner, and is going to need to be upgraded at some point, and every tech will get to that stage. And I don't seem to agree with that, because if you think about it, some of the companies that we use every day, that sort of change our way of life, really. Lives, whether that is Google or Netflix or whatever, you never hear them saying they're doing a tech upgrade. Why? Because they're in a continuously building mode. They're always building. They're always responding. They're always taking into account changing preferences, how consumers think, and they're building their products. And these are genuine tech companies. They're not media companies. They're genuine companies in media. So you could argue Fundment is in that mode, with tech company within financial services. Yes, we have heavy conduct obligations. We subscribe. We have to comply with all sorts of very demanding but necessary regulations, and that's fine. But we still innovate within that. So I think Fundment should expect it to continue to evolve. We're not the company we were when we launched, 6-7 years ago. We're certainly not the company that we were then today, and you could bet everything on it that we'll be the same company 5 years time. We'll be a lot better. And again, as I keep saying, I think the way people do financial planning is changed a lot. Planners know, advisors no longer sell product now. It's a genuine, holistic, financial structure that has been put in place, and you need a platform that is designed for that new world, and that's us. Which is why when you log into Fundment today, most firms will realize it's not a brokerage setup that you probably still see, on some of the legacy platforms. About you log in, it's all about trade this, trade that. We support that, but we're built more around deeper understanding of how people go, the Fundment system is very easy, they will love it. It's those understandings, that underpin how we built it, rather than, build a very simple, brokerage product that really isn't how people work anymore.
I love the concept of we're constantly upgrading, so there's not going to be a big upgrade. So the dinosaur, the legacy providers are like, well, the system won't allow that. It's music to our ears that there's new stuff being built. That's like you're saying. It's like you don't hear about Netflix or doing an upgrade. It's just your service just gets better.
Of clients now that you have to make sure that everything you do, you don't disrupt the service and the experience you get. You're supposed to get better, and not get worse. I think Alan's got a question.
Ola, I just want to pivot a little bit. It sounds fantastic. You are a relatively new entrant to the marketplace, and I had a thing. I just was feeling a few years ago. There's been a bit of a land grab. Companies, advisors have sort of adopted their platform of choice, and then it's going to make it tougher for incumbents. And then I started paying attention to what you guys were doing in terms of what I would call it is like building community. Like, for example, you've got this huge event on today, dinner in the evening. You and I bumped into each other last week and had a conversation about this. I'm intrigued as to why you've decided to sort of be focused on community building and gathering advisors together. I guess that's been a very definite strategy that you have embarked upon, but share a bit more about your thoughts around building community.
That is very important to us, and for us, it's not just marketing. It's a reality of who we are. Really, this is, since Fundment began, we've always got the not just the benefit of doubt, but also the alliance with advisors who really want to go on and do well for themselves and their clients. And, a lot of them have been with us from the very beginning. They've helped us understand the market. As I've said before, I was not a financial planner. I've never worked in the industry at all, other than on the asset management side. But, through advice, I've learned a lot over the years, the challenges that they face in their business, the reasons why they'll be open to walking away from long established platforms to come to ourselves. So we continue to get that, and over time you just find you have a community of really, really helpful firms around us. So what you're beginning to see now is, I don't want to say formalized, is it being formal? It's just us, really tapping into what just grew organically. We didn't set out, trying to build a community. It just happened around us. And that's a good place to be. It just showed that when you really put your heart towards something, and people can see that, and they want to work with you developing it. So Fundment, is now, something that is owned by all of those firms as well, because their input in developing it has been super vital, really.
That's great.
Andy's got, yeah, go on, Andy.
Yeah, I'm just going to chip in with a quick question, Ola. So, working with lots of different firms, lots of different advisors, with a platform, you can have a lot of different, bells and whistles and features and functions. And obviously, you've got to be quite discerning with what you build and implement into the system. My question really is, what have you deliberately chosen to not include in the platform? Like, is there anything that is a recurring theme that you're getting asked about that you've specifically chosen to avoid because it's a bit of a distraction? That's my
apart from
question.
People keep asking us, just to give a straight answer to that one, to build a CRM, and we've often said no, that's not when we're not going to build that. People have asked us, to consider, some cash flow planning. Again, we're not doing that. There are some good companies out there in that space. Even on the platform side, we don't want to go into a feature war. We don't believe in that, which is why, the way people do due diligence, I actually think is kind of outdated now. Most times you just go there, I want ISA, I want these, I want drawdown, does it do PCLS, does it do phase drawdown, all that sort of thing. Fine, it's good to sort out that. We're not really into that. We believe more in the outcome, in how long it takes to actually get things done, in the sort of time we could sort of, give back to advisors, in the work we can actually take away from them. I think someone also said, when platforms began, a lot of them push work to advisors. You got to complete the form, you got to complete this, complete that, call them, chase and whatnot. We are reverse engineering that. We want to take work away so that you can actually concentrate on what matters, really. So yes, we think very deeply about what feature we're building. If it doesn't lead towards very good client outcome, we just won't do it. Or if we don't think we have any advantage to bring to the process, you won't see us there. You're not going to see us in a launch, multi-asset fund, for example, because we think we get a few basis points off the back of it. That we won't see. But you probably see us, investing more in anything that could drive the financial planning process. And you're going to see a lot more investment in that space by us going forward.
Okay. Nick?
Oh, good. We run out of questions.
No, I think we still. What? So, the tech thing, the ownership of tech, Ola, is such an important thing. I think that as a USP, I'm not telling you how to do your job, but it sounds like I'm telling you. I would be pushing that harder and harder because we've seen these problems with these platforms that are powered by FNZ and other ones. They have these horrendous issues when they re-platform or when they try and upgrade their platform, and having the software in-house that you're continually honing all the time, just sharpening the saw all the time, is such a big thing. And I think, again, younger advisors maybe don't appreciate that. I just think it's massive. I think it's to your immense credit as well.
Thank you. We are working very hard, in making sure that the wider industry, understand exactly the power of of the technology we're building here. And when people say the service is good and it's simple to use, it speaks precisely because of that. We're going to keep working on making sure that the rest of the industry knows Fundment and it knows it really, really intimately. We're lucky today. We already have over 800 firms, varying sizes, some nationals, some big ones already. So we're already there. Thanks, Andy. Thank you very much for that small applause. Although I can't hear it, but there it is.
So, when are we going to hit 1,000 firms?
No,
after this episode, surely.
Hopefully before the end of this year, and I will be sure to shout about that when we get to that milestone. But
best of luck on that journey.
But we would love pretty much every firm we care about financial planning to truly understand who we are. We're not into the sort of marketing and social media, and I'm not slagging off marketing and social media at all. We're just a very real company with real people that just truly want to help move the industry forward, and we're getting all the support that gets us there.
And for the listeners and the viewers, you've recently moved into your new HQ. I say recently; it's probably a couple of years now. How's that going? Is that going really well? You're doing a lot of events there, and
it's going really well. Yes, it's going well. We moved in September 2024. So that's just over 16 months ago.
Yep.
It's been good. We've scaled up the team over there. We moved into 2 floors within the building, the 6th and the 7th. I think our head count is now, approaching 80 now. There's not enough room anymore for the team, so we're taking another floor in that building. As we continue to scale up our, technology and operations team.
Brilliant.
Here, we've intentionally kept the 7th floor for the advisors. You talked about community. We have a lot of advisors who, come to see us, see their clients over there. We host a lot of events there. Some of them quarterly. I believe we have 2 or 3 events at some point this year. Outside, first annual conference, which takes place in 2 days' time, 3 days' time. 2 days time.
Actually, it's today.
Today's Monday, so yeah, exactly. It's on Thursday.
Yes, when this goes out.
So that this building as well is partly our commitment as well to just bring in the financial planning community together. Yes, it's going well, and it's going really well. You've been a few times, haven't you?
Well, I was just going to say that. Yeah, we've been there. We met in your fabulous office last year. We were sort of discussing various things. Incredible space you've got there, and you're right. This is what I keep coming back to: this idea of community. Advisors get there. You've got all sorts of events and get-togethers. And I'm just trying to think that there will be people watching or listening to this episode that are probably interested in learning a bit more about Fundment. What's the best way for them to engage, connect? Can they register for an event, even though they're not using you guys yet, but they just want to learn more? What's the next step?
Our events are any financial planning firm. You do not have to be a Fundment user. You are absolutely welcome to attend our events. A lot of those events are published and marketed through our social media pages. They tend to sort of get filled up very, very fast. I believe our conference was sold out within a few days. We're expecting 400 odd firms, people there anyway. So it's one of those where people need to sort of jump in once those events are released. Myself, the team, our distribution team, we're all over on LinkedIn. You could get us there, or just email us. You can. My email is personally easy to get. Ola@fundment.com. You can't miss that, really. I get emails from everyone. So honestly, just come after us. Reach out to us, ask us questions. We're an open book, really. You could ask us anything about the business. Where we are today, where we're going. We're just a company that's building for a long, long time.
Brilliant.
Great stuff. I don't think we've got any more questions for Ola. I think we've.
No, that's been brilliant. Really helpful. Great insight.
Yeah, really appreciate that, Ola. I'm looking forward to today's event, because today is Thursday, Ola, not Monday. Today's Thursday, right? Looking forward to this a lot. I just want to close on this thing about community. I think we've, with what you're doing at Fundment, it's not just a platform. It's a community you're building there. What we built with the Real Advisor podcast is a community. There's a crying need for somewhere where advisors, quality financial planning-led advice, can congregate and talk and chew the fat and learn and help each other along. And I think what you're doing is amazing. And if you're considering a slick platform that lets you focus on the financial planning and the platform doesn't get in the way, you do a lot. You do yourself a massive favour by looking at Fundment, kicking the tires on Fundment. I mean, they're partners of the show. We love to be aligned with them because they share a lot of our values. Ola, I'll let you go, fella. I'll catch you later, and you can buy us all a drink, or we'll buy a drink.
Thank you, Ola.
Ola, keep your browser window open, Ola. But just if you can keep it open after I kicked you out, because the files need to upload in the background. Okay.
Yeah.
Yep.
That makes sense.
See you soon, my friend. Thank you very much.
See you soon.
Thanks, Ola. See you soon.
Right, very good,
awesome.
Very good, very super switched on guy, it's a really good plan. I mean, they were doing fully digital stuff. I think before the Wuhan lab leak kind of forced other firms to DocuSign, and they've got DocuSign baked into their platform. You don't have to third party it in or anything like that.
They're
very
a proper tech company.
Yeah.
They're not just
an
insurance company that's bought some aging tech and
correct and
landed it together. They just built from the ground up. They've got their engineers on site in-house building things continually. Yeah, really
having
good
their own
company.
software. I can't tell you how important that is. Okay, let's.
Agree.
Great stuff, and let me look forward to seeing some of the TRAPist today.
Do you want to say something, Nick? Your hand is raised.
Yeah, thanks. I'm just doing the soundboard card. You're welcome to do it yourself. You can have a go. Media. Let's move on to the TRAPist questions, because I can see posters at the front door, though I can see that my soundboard is completely frozen. Okay. There she goes. She's holding the bulging sack of TRAPist questions up my drive. If you want to leave a question for the Trap Pack to answer, look at the pinned tweet on X, the pinned X on tweet, on Twitter, whatever, and or in the so-called show notes. The link is always there. We do get through them. We do them in order that they're submitted, so we're still a few months behind. We've got a few more questions to go to. So let's have a look and see who this one is from. This is from Wilson R. We had a Wilson M last week. Wilson R. I think this is the same person, just changed their initial. He says, or she says.
They say.
Let's go with she. Let's go with she. She says, there seems to be a theme going on where advisors are demonising the fact we earn from AUM and are proposing a fee model. What do you think about this? Do you think this is likely to be changed in the future? And if so, how will it affect the industry? Oh, crikey, Alan. I mean, you're well known.
Don't.
I'll go first.
When did you upload this question? Because I looked earlier on, there was no question.
There was no
is this
question.
A lastminute.com
again.
No, it's put about 2 hours before the show recorded.
I'll give it the first crack and then over to Alan. Yeah, so the AUM fee model is the worst fee model out there except for all of the others. Alan.
That's
I've
softened my stance. I think, did he say this, R. Wilson, she said that advisors are being demonised. I'm not sure about that.
Advisors are demonising the fact.
Okay, it depends which advisors.
Third party, the NACs or whatever, I don't know.
All right, well, look, I've been vocal about this in the past. I've softened my stance. The fee model should be the fee model that works for the advisory firm and the client is happy to work with and understand. I do think we ought to be more pricing, and that all the stuff that sits with pricing and value is a really, really important part of any commercial enterprise. You should pay more attention and not necessarily just rely on what everyone else does. I like the concept of more like dynamic pricing. There are some things you should be, if everything defaults to, I'm charging 1% of assets, regardless of the service experience, the client's issues, challenges, complexity. I do think that's a flawed model. I don't necessarily think that everyone should be in a retainer or an hourly rate. I think people should be a bit more thoughtful about their pricing. And I mean that from both the client's experience, but equally as important from the advisory firm's experience. I think we've touched on this in the past, and we might come back to it again, because I continue to hear stories speaking to other advisory firms who are seeing some real threats to their revenue model because as clients spend down their assets, clients give away money to their children, grandchildren, pay off their debt, pay off mortgage, help the people on the property ladder, all that sort of stuff. And then clients are doing exactly what we've been telling them to do for years, which is to spend their bloody money. And when someone goes into retirement and they're in drawdown, we all know there's a lot more complexity in that world. With all of it, and all the new legislation that's come up and inheritance tax rules pertaining to pensions, there's a lot more complexity, a lot more risk, a lot more work. And at the same time, the advisor is earning less on a depleting asset value on the simple ad valorem model. All I'm saying, make your own rules. Everyone can run their business how they choose to do and engage with their clients. But maybe, just maybe, being a bit more thoughtful about pricing strategy might be the sensible thing to do. That's it.
Yeah, I agree, Alan. And Andy, you couldn't have put it better. Like, it isn't perfect. It's far from perfect, in fact. But the beauty of it, we mentioned it earlier on, about investments and simplicity in investments. It is quite simple and it's quite easy to explain. And I would say anybody setting out, you got to figure this out. Like, even Alan, you saying that you've softened a bit, we're trying to figure this out still to get. Can we get a better model, something that works a little bit better for us and for our clients? So I think this is work in progress for everybody. And in Ireland, like it's we still have commissions, so like it's the range is like absolutely enormous. But yeah, figure something out that works for you. Just do it with integrity, I would say, and do it across, whatever you decide, everyone gets treated the same way. But you might have tiers or whatever based on what Alan said there, So, but yeah, it's not perfect. You're not going to find. It's like trying to find the perfect investment. It doesn't exist either.
Yeah, here, well said. Well said.
I think that's the key point, the integrity element, because some people focus on the fee structure being the integrity, where it was actually it's the individual and the firm. Tell me the most highest integrity fee charging structure out there. Okay, got it. And I'll put a crook in charge of that fee structure, and they will cause damage. You tell me the slimiest fee structure that you deem, and put angels behind it, and they'll do their best for their clients. So the integrity is the individual and the firm, not really the fee structure. I think many people have tried different fee structures, charging flat fees for people that are accumulating and Henrys, and they've just caused themselves no end of pain. Lots of advisors have switched to fixed fees, charging on net worth, charging on investable assets, and then have switched back to ad valorem. So there's a lot of experiences that have concluded that it is the worst except all the others. I'm sticking with that.
That's brilliant.
Well, yeah,
Alan.
I think I've shared some information in our private group this morning about something I came across. And again, we might come back to this. You used a phrase in the past, Andy, about pointing the guns in the right direction. I think fee models are important. They're not the number one thing, as you rightly say. You have the perfect fee model with a crook as an advisor. That's suboptimal. Yeah. And it's not the part of the mix, for sure. Firms should be a bit more thoughtful about it, apply the thing that works for them, whatever it is, and the thing that works for their clients, because there are so many more challenges. And we often talk some things we can talk about public, some things we can't talk about. But we see what I would generally call sharp practice operating around the sections of the industry, and that's far more important. Some of the work that goes on that it doesn't have high integrity, but a beautiful pricing model. So we should probably spend more time on that than arguing over which fee model is best, because as you all say, there is no best.
Yeah.
Okay.
Great.
Fair enough. Okay, let's move on. Alan, lower your hand. Culture caller.
I think you actually raised your hand whilst you were talking, which is an amazing thing. Is this culture corner? Yeah. Okay. Can I just say one thing? Right. I got really cross about something earlier on, and I'm not sorry that I got really cross, because I'm not going on public record about that stuff. But what I will say, Trap Live is coming up, and as part of Trap Live, we do have a questions and answer session that will not be recorded. And I'm more than happy to address said issues in the questions and answer session in Trap Live. and I'm more than happy to stand my own ground in that. Anyway, I have two things in Culture Corner.
We're going to sell ringside seats for that conversation, Carl.
Yeah,
you sold another 20 tickets now.
And I'm totally okay to stand my ground on that one. Totally and utterly. Anyway, Rich Roll podcast. I can't even remember what my Culture Corners are now.
Dr. Will Bushes.
Yeah, that's really good, and that was kind of appropriate for me. In true Michael Kitts' style, be sure to listen to the end. It gets better. It's a long one, though. The other book, I've had a bad back, so I've been lying on my back for a lot of the last couple of weeks, and I haven't been able to work, so I've been doing a lot of thinking. There's been a lot of great stuff, and I'm going, oh, geez, yeah, I should do that, because I've taken the time out. So this book is... Can you call it out? Because I haven't got the notes and I forget what the book is.
Cal Newport,
Slow Productivity, the lost art of accomplishment without burnout.
Cal Newport. And how I found him, actually, he was also a guest on the Rich Roll podcast about a year and a half ago. But I didn't love the book, but I love the concept of actually sometimes slowing down to focus on just a few things and then doing those with real quality and focusing in on just a few things. I love the concept of that. So yeah, they're my two Culture Corners.
He's very good, by the way, Carl Newport. He's got his own podcast.
He did Deep Work, didn't he?
Deep Work was his original book. Just all the distractions that come at us and just focus, just Deep Work.
The book isn't fabulous, I will say that, but the concept is.
Check Deep Work, his first book. Okay. That's probably better.
Oh, as Andy's front door goes. There we go. Excellent. Right, next.
I changed mine because I've just finished reading this book. And I say before, we share all these things, and I'd always wonder how many people actually say, oh, because Carl said it or Alan said it, so I'm going to buy that and read that. I really recommend this book. I seriously recommend it. Certainly if you've got a business. I mean, it applies for everyone, but if you're growing a business and you've got a team, this is the book called The AI-Driven Leader by Jeff Woods. It's brilliant, right? Without going over all that old stuff, AI, artificial intelligence, what have you, because I think on a personal basis, I got excited about it, sort of ran away. We got some quick wins earlier on. Then I've been thinking, well, where's all the other breakthroughs coming from now? And it kind of, there's a natural cycle then in new technology. You sort of, it peaks. Everyone anticipates it's going to continue like this forever. And then some of the things, people are, I don't know, writing LinkedIn posts or creating funny images or something. Well, wonderful, but that's not necessarily complete, breakthroughs for companies.
Yeah.
So actually, I had it already. I got Spotify. You get free books on Spotify. It's brilliant. Certainly have audiobooks. So I'm now listening more. I used to always just read on Kindle. So I listened on Spotify to this. Shouts out to Martin Chappell.
Give me the name there again, Alan, please.
Sorry?
What's the name of the book again?
It's called The AI. There's a link to it in the show notes, Mr. Widger. But
I never look at that.
It's called The AI-Driven Leader. AI-Driven Leader by Jeff Woods. And he's got a whole... He's got a website, which I think, again, link in the show notes, AI-drivenleader.com, with a whole lot of stuff there. You do a little questionnaire, and you can download a lot of stuff. And he's got a little crash course, effectively, because this book is written for CEOs, founders, senior-level people in companies all around the world who's saying, look, oh, God, I need to get into this AI stuff, but I don't really know much about it. I don't know where to start. So it literally tells you this is what you must do. Here's a project. Here's a thing to do. Just type this stuff or speak into it, and you just begin to utilize the technology in a far better, more effective way than I've ever seen it done before. Strong recommendation from me. I was just about to say shout out to Martin Chappell from Dimensional, who mentioned it to me as well. He's just read it. Says one of the best books he's ever read. So particularly for you, for everyone, but particularly for you, Carl, to get your head around it, I recommend it. You can listen to it.
I've already downloaded as you're speaking.
Good man.
Following on from the AI theme, I think one of the smartest companies in this space, Google DeepMind, founded by Demis Habibis, they've got a brilliant documentary on YouTube called The Thinking Game. Definitely watch it. Strong recommendation. And it travels around with the DeepMind team for 5 years. Pre-COVID, COVID, post-COVID, and all the challenges that they're trying to do along the way. They're doing some awesome work. So do check that out. It's a London-based company, so I've been following them for a few years. So The Thinking Game on YouTube.
Yeah, it's really good. It's good. It's really interesting.
Great stuff. Great stuff. I don't have a culture corner for this episode, so we've got.
Oh, Nicholas.
Well, if you haven't got something to contribute on this, don't. I haven't finished any books. I haven't seen anything on television or podcast that particularly grabbed with me. So I will hopefully have something for the next episode.
No, that's what we're saying. That's what we're saying. We're not just adding these just for the sake of adding them. If we are adding them, they're going to be pretty good on average. I just want to reiterate that. And by the way, we need more reviews, please.
Yeah, we do need more reviews.
Yes.
In fact, as you see us today at Fundment Live, the Advisor Edge, come and talk to us, and we will question you. And if you haven't left a review, Andrew will give you a good slap. How about that for a deal? Okay, episode 89 is sliding down the U-bend of Father Time. Thank you, dear Trappist, for your time. Please do leave a review, and also do likewise on YouTube. Hit the subscribe bell button, whatever it is. You'll get notifications when the new episode slides out. In the meantime, it's thank you and adios from the Trap Pack. We'll see you on the other side. Take care out there, folks. Adios.
Bye-bye.
Get your tickets
See you
to
later.
Trap Live.
Holding the ticket officer. Mr. Lincoln, we got 28 tickets left, mate. Right, we're down to 28 tickets. Go get.
Boom.
Goodbye.
Get in.
Done.
Have you stopped recording, Nick?